Are you a 401k millionaire? If you are, congratulations. You are among the very few that ever do reach that milestone. And in today's video, we're going to be breaking down the 401k millionaires and show you exactly where you're at. And you can look at your 401k and know exactly kind of where you stand. Now, when we think of a 401k plan, they're employer-sponsored retirement plans with a tax benefit. If you're going in there, you can do a traditional, you can do a Roth, makes a big difference. But when we think of 401k plans in general, they are the largest retirement plan or the largest retirement fund that pretty much anyone carries. When we start thinking of the total amount of assets, they're sitting on almost $9 trillion in assets with over 70 million participants, which is kind of crazy to think $9 trillion in assets are sitting in these 401k plans. Now, when it comes to the average balance, this is where it gets interesting. Average balance of your $9 trillion in assets is 132K, according to the research study done in Q3 of 2024. So when you think of 24.4 million participants that they really evaluated and broke down, that was the average balance in the account was 132K. Now, when we start thinking of the highest average balance, this is at retirement age. So when we think Social Security, you can start collecting at 62. Full retirement age as of today is at 67. So the highest average balance is 65 to 69 years of age with a balance of 252,000. Now, thinking of that average balance, we are still quite a ways off from that $1 million mark in that 401k plan. Now, very few Americans have reached the $1 million in that 401k, and some of those have worked incredibly hard to get there. According to Fidelity, 544,000 individuals are 401k millionaires. Think about those numbers for a minute. So if we have 544,000 individuals that have reached that seven-figure mark of a 401k millionaire, thinking of 24.4 million people that were participated in the study, that's kind of a very tiny minority of roughly 3% or just a little bit less than 3% based on that. Now, when you think of building retirement really takes time and effort, constant contributions going in there. And if you don't start early, which is what we're looking at, you're going to struggle to catch up. If you start and really, if you wait to start your retirement savings at a later age, it is going to be incredibly late. And that is what we're seeing. So traditionally, what we're seeing today is people are starting these retirement plans at about 30, 35, and even 40 years of age. The reason is when you start looking at childcare, the consumer price index, the cost of things itself, mortgage, tuition expense, they are offsetting about 10 years. It's actually a 10-year curve that we're seeing where people are starting contributions into 401k plans. So once you go through, you get your college education, let's say you're 22 to 24, depending on when you started, finally land that job, you're 25 years old. If you start at this point making regular contributions towards that milestone, you can do it and you can hit this $1 million. Now, a study shows that 20% of Americans age 50 or older have no retirement plan at all, meaning when it comes to 401ks, when it comes to IRAs, they have absolutely nothing saved at all, which is truly disappointing. So if your goal is to retire with that $1 million or more, there are some very important things to do to reach that milestone. Small contributions add up over time when you look at compounding interest. When we start looking at 401ks or IRAs, if you start at age 25, now again, for a lot of people, age 25 contributing $420, getting a 7% yearly return, by the time you hit 65, you will be at that $1 million plus. You'll be part of those 544,000 individuals or less than 3% that hit the $1 million mark. Now that is only at a 7% return, which is pretty good. $420 when you're age 25 might seem like a really big amount to put in there, but you have to think when you start going through this, and again, thinking the compounding interest, if you're contributing over the 420 a little bit later in life, you can catch up to these contributions pretty quick, but you can't wait too late. If you're starting at 25, by the time you're 27, 28, or even 30, you've already lost an incredible amount of compounding, meaning you're going to have to really put in a lot more money to get that $1 million mark. Now, it is very crucial to start earlier. And honestly, with the market fluctuations, you're buying it when it's up, you're buying it when it's down. Staying and really maintaining a diverse, balanced portfolio is a huge thing. Now, for me personally, looking at target date funds, we have in what my employer offers, our Vanguard target date funds. Target date funds traditionally have underperformed the broader markets by a pretty significant amount. When we started looking in comparison to the last 10 years of a target date fund, roughly about 6 to 7%. When I started looking at the S&P 500 funds, roughly 11%. It's kind of crazy to think when you look at an average of a 10-year, earning 7% versus 11%, that compounding interest in there can be an absolute game changer. Now, of course, when you start looking at 401k plans, a lot of employers offer a match. When you're looking at the employer-sponsored match or looking at a match in general, you're getting a 100% guaranteed return, which is kind of crazy. It is the only place that you're going to find a guaranteed 100% return, which is the reason why I really encourage you, if your company offers a match, before you do anything, before we get into savings, before we get into debt repayment, before we get into anything, putting money and getting that employer match at a very bare minimum. What I traditionally see is individuals will say, I'm going to start putting money into the 401k after I eliminate some of this debt. All of a sudden, 3 to 5 years later, still have a little bit of debt around. Now you've lost 5 years of contributions or matching within the 401k plan. So as of 2024, Vanguard report stated that 95% of retirement plans offer a match. However, when you look at the actual contributions, roughly 80 to 82% of people actually contribute to the match itself, which is kind of crazy. Now, when you think of the US itself, living paycheck to paycheck, never finding enough money to put into a 401k plan at all, roughly 25% of all US households are reported to live at a paycheck to paycheck in 2024, meaning when you automate the 401k plan, it is the effective saving strategy that you can put in there. And honestly, you can even coincide this with your raise. So what we mean by that, let's say you get a 3 or 4% raise. If every single year that you get a raise about the same amount, 3 to 4%, which of course we know is average, putting 1 additional percent rate into the 401k, you're not even going to miss it. Your salary increase might not be as much as your take home when you get your paycheck, but you know that money and that automatic payroll deduction that's going into the 401k plan is really making it a lot easier. Now, of course, if you're not eligible for a 401k plan, if you cannot get one, this is the time when IRA accounts are going to make the really big difference. Setting up those automated transfers from your bank account or to an external account somewhere else. I choose M1 Finance or Robinhood to have some really good IRA accounts, making sure that you're putting it in there if they don't offer any kind of employer match, and making sure, again, that you have the potential and can retire with that $1 million mark or more if you're making those consistent contributions. So overall, guys, when you start looking at it, I mean, there's a very small amount of people who actually have that $1 million in the 401k. We talk a lot about net worth calculators, everything of that nature. For me personally, I don't believe that mortgage and mortgage value should go in there. This is just my personal bias, but I feel like when it comes to calculating your net worth, excluding out the mortgage does give you a lot more realistic picture of exactly what you're looking at when it comes to net worth, and taking that out of it, because essentially you'll never see it unless you sell the place, unless you have the asset. Essentially, when you sell the asset, that's going to be taken out of that net worth calculator, and it's going to be a little bit different when you no longer hold that asset. But again, I don't count it just because I think it skews a lot of the averages. Sorry, guys. So that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.